Right, so we have this premium wick, consequent encroachment in the upper quadrant and lower quadrants, and the high and low of it annotated here, and then this premium wick. So make sure you keep track of what these levels are here on the daily chart and what you're looking at on the smaller time frame. So we have the pre-market session buy side liquidity pool. So here's the opening at 9:30 Eastern time. So at that moment, there's a minor buy side. Here's a more prominent buy side liquidity pool, and it's not likely to go up to this one here because we've already created that high in the pre-market session, 7 o'clock in the morning. So it's already done enough of a run up there, and it's been rejected. Keeps going lower. So this was the buy side liquidity pool. It aimed for, hit it, and then attacked the sell side inside this premium wick. You see it came right back up, hit the consequent encroachment level at 24,874.5. Breaks outside of the low of that premium wick here. So it's trading right here now. Okay. And this first presented fair value gap is a SIBI, not using 930. So this is the first one that formed. So this is the first presented fair value gap, and the market trades up into it and rejects and trades down to per quadrant at 24,790.5 of this premium wick here. That's here. So we traded down to here, and we bounced right back up into 24,836 area and created relative equal highs. Now I'm going to move forward in the chart. Here's that first presented fair value gap, and then that bounce off of it in the relative equal highs. And we consolidated around the high of this candle's wick, meandering around. And then we broke lower. That fair value gap that's bearish here after leaving this block of price action. While bearish, trading right back up into this. This is model 2022 because we had buy side taken here. Shift in market structure, trade back up into a fair value gap that's in a premium, and then it breaks lower. Here's a breaker. So high, low, higher high, bearish breaker trading into it there. And we have an order block that's bearish, which is changing the state of delivery. Breaks lower, breakaway gap as it leaves the consequent encroachment of this premium wick. So where's it going to reach for? We have this area here, but this fair value gap is basically creating a sell side liquidity pool. So it's more likely we're going to trade down into this area here. So having the quadrants on that, creating that price swing. So the low of that candlestick is the high of the fair value gap. Consequent encroachment, upper quadrant, lower quadrant, and the low of the fair value gap that's shaded in blue. So it's trading right here at 24,655, right here. Getting down into that, and then the lower quadrant there. But as it breaks lower, we get into the low at 24,713.75 of this premium wick right there. And then it creates the measuring gap, breaks lower, bearish fair value gap, comes right back up, hits it again, then slams into the upper quadrant of the fair value gap there. And then we go off that and consolidating. You can see consolidation led to another deeper retracement up into this bearish fair value gap. Extended over, breaks lower, comes back up into the low of this premium wick here. It starts consolidating around it, and then trades right back up to the bearish fair value gap and goes into the close of the day, just between the fair value gap and the quadrant of that premium wick right there. So hopefully you can see the benefits of having the gradient levels over top of premium and discount wicks. The question about why did I use one wick and not another? And it's because I start with the first one going to the left, and I have those levels there on the chart. And then I have this one would be the next one I would have on there. And I'm looking for the one that the algorithm is respecting. It's not likely that both of these, when they're basically subsequent candlesticks, like one after another, that have wicks, if, for instance, if we plotted both of them, the chances of them agreeing right over top of the same levels it's not likely. But even more so, the chances of my PD arrays overlapping and converging with both of them being plotted on the chart is not likely. So what I was doing was, and this is the part where you're supposed to do this stuff on your chart, not just look at my charts. By having both of these plotted on yours, and it's not being shown here on the chart here, but if you plot the discount wick on here and discount wick on here and put the gradient levels on it and watch how price was respecting it or not respecting it, you'll see the reason why I chose the one I did. You have to watch what price is doing. Is it respecting one particular inefficiency or one particular wick and not another? So it's not like here's a hard and fast rule that always works. You have to put some elbow grease into it and apply some due diligence by looking for what the price action is actually doing. And it'll be obvious which one you're supposed to be using, but all the time, like I mentioned on the very first lesson last Tuesday, you have to consider what wicks are available when you're trading at all-time highs and use all of them. Go back and look at the rules. Okay, it's there, but it doesn't remove the workload for you to have them plotted on your chart and see if there's any validity to one wick over another. One wick will be respected, and it's your job to determine which one that is while price is delivering and before the next move happens.